Good afternoon, folks. It's the Liberty Call for Wednesday, January 26, 2022. I hope everybody's having a fantastic Wednesday out there in the interwebs. It is hump day. So if you have a camel and you like, was that Geico or one of those commercials? So we finally have a clear day. I cleared off about 6 inches of snow off my driveway this morning. So I had to get up extra early because I had to head into town later today or later this morning for my infusion. Had to get my refill in my hand of Remicade, so I'm good for another 6 weeks. Although, let me take a minute to complain about the practice there. They still are insisting on wearing masks. It is the only place in the goddamn world where you have to put on a stupid mask to walk into an office. It's just ridiculous. Plus, I have a mask exemption due to a medical problem or medical situation. And they don't seem to want to respect that. So I'm not sure what I'm going to have to do. Maybe get the medical board involved or whatever. So it's I'll keep their name out of it for now. But anyways, if it's your first time watching, be sure to hit the subscribe button, like and share with friends and family. I would greatly appreciate it. So let's go ahead and jump in to see how the markets did today. All right, the Dow Jones closed down 0.38. 38% to 34,168. The S&P 500 closed down 0.15% to 4349. NASDAQ was up 0.02%, closed at 13,542. Small caps were down 1.61%. The VIX was up again to 2.57%, closed at 3196. So for anyone who, if it's your first time watching, the VIX is something I pay a lot of attention to. And anytime it's over 30, that is a real cause for concern. So if it doesn't trickle down below 30 and head back towards 20 here in the next couple of days, it might mean we're headed for a lot more volatility and potentially, a slide in the markets. All right. Across Europe, mostly green. Looks like the only red I see is the S&P BMV IPC. I'm not sure what that one is. But everything else, up 1-2%, looked really solid. Same across Asia. There were two that were down. The Nikkei was down 0.44, and the S&P ASX 200 was down 2.5. But everything else looked was in the positive across Asia. So Asia was kind of mixed. Europe looked really good, and then here in the United States domestically looked pretty good. Most of the time the market was open today. I know I was checking it when I was out and about today, looking, keeping track of where things were, and I thought the market when I get back here to my office that the market would be up for the day, but. No, not really. It reversed everything. And I think a lot of that had to do with Powell talking his news conference this afternoon. So, all righty. Let's go ahead and jump into a couple of articles. This first one, S&P erases gains to close lower as Powell relights Fed hike jitters. And I don't know why people have jitters about raising rates. I mean, paying interest on a loan. I don't think that's nearly as objectionable as a lot of people seem to think. But the market's going to go through some volatility. I don't think that is, I don't think there's anyone out there, that does investing for a living that seems to think that this is going to be some sort of smooth ride over the next, year or two. So hold on one second. Excuse me. All right. Let's go ahead and breeze through this. This was written by Yassine Ibrahim from investing.com. The S&P 500 closed lower on Wednesday as tech gave up some gains on surging U.S. bond yields, as Federal Reserve Chairman Jerome Powell hinted that there was plenty of runway to raise rates, with the first hike widely expected in March. The S&P fell 0.2% after rising about 2% intraday. The Dow Jones Industrial Average fell 0.4% or 129 points. The NASDAQ was flat, erasing a 3% gain during the day. In his press conference that followed the Fed decision, Powell said there was quite a bit of room to raise rates without hurting jobs, stoking expectations that the Fed's plan to tighten monetary policy measures, which have been underpinned risk assets, may be more aggressive than expected. The remarks arrived after the Fed said in a statement that it may soon be appropriate to raise rates and confirmed plans to end its bond purchasing program in early March. With inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate. The U.S. bond yields surge, putting a dent in growth sectors of the market like tech with the U.S. Treasury yield. Microsoft was up more than 5% intraday, gave up some gains after the tech giant delivered an optimistic outlook on revenue following better than expected Q2 results. For the third quarter, Microsoft guided revenue between $48.5 billion and $49.3 billion compared to Wall Street estimates of $48.9. Microsoft's cloud guidance was stronger than the street, and when factoring in FX headwinds, we would characterize this as a blowout guide in terms of how investors will digest these numbers. The bullish results from Microsoft helped steady sentiment on growth sectors of the market, including consumer discretionary following days of selling. Tesla, which is set to quarterly results. Probably set to release quarterly results after the market closes, was well off the highs to close 2% higher. Apple, which is set to report quarterly reports on Thursday, ended the day roughly unchanged after pairing gains. Boeing, down 4%, failed to join in on the broader market melt up after the aircraft maker reported a wider than expected loss in Q4, and revenue fell short of estimates as the delayed deliveries of its 787 Dreamliner program hurt performance. So that's kind of the gist of what happened today. The market was going along fine. Fed chairman came out and said exactly what we would expect him to say from a perspective of, we're going to raise interest rates starting in March, and we're going to stop buying bonds. I mean, I guess there's traders out there who seem to think that the Fed is just, bluffing that they're going to raise interest rates. I mean, I know the markets and, the investors as a whole seem to like rates down at zero because you can borrow for nothing and, invest that money and, make more money on that. But I mean, it's hurting the economy. We've kept rates at or near zero for going on nearly 15 years. And we've built up all this malinvestment in the system. We got to flush it out. So, I mean, the only way to really do that is to raise rates. It's going to have some negative effects on the economy, but, a lot of these businesses probably shouldn't still be in business. All right. Other good news. Oil breaks $90 a barrel for the first time since 2014 on Russia tensions. This was written by David Gaffin from Reuters. Oil rose on Wednesday, touching TUOCHING. These people should really proofread their work. Touching $90 a barrel for the first time in 7 years, supported a tight supply and rising political tensions between Russia and Ukraine, added to concerns about further disruption in an already tight market. Brent crude gained $1.76 or 2% to settle at $89.96 a barrel after surpassing $90 for the first time since October of 2014. WTI, or West Texas Intermediate crude, closed up $1.75 or 2% to $87.35 a barrel. Oil prices edged off their gains in post-settlement trading, retreating with other risk assets like equities after investors interpreted U.S. Federal Reserve Chairman Jerome Powell's comments in a press conference on expected interest rate hikes as somewhat hawkish. Again, this is not a surprise. I don't know why people are like, oh, we're completely caught off guard that they're going to raise interest rates. Russia has amassed thousands of troops on Ukraine's border, fanning fears of an invasion. Energy market prices rose on worries that Russia's gas supply to Europe could be interrupted. Russia is also one of the world's largest oil exporters. U.S. Secretary of State Tony Blinken said on Wednesday, said the United States will make sure global energy supplies are not interrupted if Russia takes action. Markets are nervous that physical supply could be disrupted, said Paul Sheldon, chief geopolitical advisor of analytics at S&P Global. Most likely, flows will continue, but the risks are not negligible that someone could affect physical balances. On Tuesday, U.S. President Joe Biden said he would consider Personal sanctions on President Vladimir Putin if Russia invades Ukraine. I bet Vlad is probably shaking in his galoshes. I mean, he's one of the wealthiest men in the world. I don't think Joe Biden is of any concern to him. Separately, Yemen's Houthi movement launched a missile attack at the UAE base on Monday. Global political tensions have added to worries about an already tight energy market. OPEC Plus is having trouble meeting monthly production targets as it restores supply to markets after drastic cuts in 2020. And the United States is more than 1 million barrels short of its record level of daily output. If we had more oil wells, we probably would have more oil. I don't know. The only organization that can change the course of prices now is OPEC, said Claudio Galimberti, Senior Vice President of Analysis at Rystad. Meanwhile, demand remains strong, suggesting inventories may decline further. The organization of OPEC Plus meets on February 2nd to consider another output increase. Inventories in the United States rose last week, with crude stocks up to 2.4 million barrels against expectations of a modest decline. Gasoline inventories rose to their highest in almost a year, a needed salve for the market. U.S. refined product supplied a measure of demand, surged again, putting the 4-week moving average at 21.2 million barrels a day, ahead of pre-pandemic trends. The increases have been led by consumption of distillates like diesel, as gasoline use has been weaker in recent weeks. So it doesn't look like at the moment we're going to see a reprieve in fuel prices. So for those of you on fixed incomes or, at the bottom end of the income spectrum, it's going to be tough for a little bit longer. So, if we only had that Keystone pipeline, hey, we'd probably get more oil down to the refineries on the Gulf Coast. But what do I know? All right. Last article, U.S. goods trade deficit hits a record high. More bad news. Retail inventory surge. This is written by Lucia Mutikani from Reuters. The U.S. trade deficit in goods widened to a record high in December as imports increased for a fifth straight month amid strong domestic demand, suggesting that trade likely remained a drag on economic growth in the fourth quarter. But imports are helping to replenish depleted inventories, with the report from Commerce Department on Wednesday showing a strong restocking at retailers and wholesalers last month. Solid inventory accumulation likely offset the impacts on gross domestic product from the larger trade gap, prompting some economists to raise their growth expectations for last quarter. Strong demand and shifting consumer preferences during the pandemic led to a surge in imports that continued to outstrip exports and is contributing to all-time highs in the deficit, said Rubila Farouki, chief U.S. economist at High Frequency Economics in White Plains. The goods trade deficit rose 3% to an all-time high of $101 billion last month. It was also the first time that the deficit breached the $100 billion threshold. The rebuilding for inventories could keep the goods trades deficit wide at least through the first half of this year. Goods imports increased 2% to $258.3 billion, likely as the backlog at ports continued to be cleared. The increase in imports was driven by capital goods, motor vehicles, and consumer goods, but imports of food and industrial supplies declined. Goods exports rose 1.4% to $153 billion. There were increases in exports of consumer goods, industrial supplies, and motor vehicles. Capital goods exports also rose, but food exports tumbled. The report was published ahead of Thursday's advanced fourth quarter GDP data. Trade was subtracted from the GDP growth for 5 straight quarters. According to a Reuters survey of economists, the economy likely grew at 5.5% annualized rate last quarter, an acceleration from the third quarter's 2.3% pace. Inventory investment likely accounted for much of the anticipated acceleration in GDP growth last quarter. Growth last year is expected to have been the strongest since 1984. Well, because there was no growth the previous year. I mean, come on. It's ridiculous. All right. The Commerce Department report showed retail inventory shot up 4.4% in December after increasing 2% in November. Inventories of motor vehicles and parts jumped 6.8% after rising 4.3% in November. They had been hampered by a global semiconductor shortage, which has undercut motor vehicle production. Retail inventories, excluding motor vehicles, accelerated 3.6% after rising 1.2% in November. This component goes into the calculation of GDP growth. All righty. So I'll go ahead and stop that there. So basically, and I know I've harped on this probably for the last year and a half that, the more goods we have going out versus coming back, or I'm sorry, goods we have coming in versus going out means that when we sell our goods out on the open market in the international space, we're getting, or we're buying stuff from them, and then we're pushing out US dollars out into the international market. So anyone who knows anything about supply and demand knows if you have an oversupply of anything, the value will go down. So we've continued to flood the international space. We've been taking all their stuff, but giving them US dollars. There's going to come a point where, the rest of the world is going to say, we don't want these dollars anymore. We want gold or Bitcoin or something that's certainly more, even a barrel of oil at least will hold its value compared to the US dollar. So anyways, yes, we've been very lucky for the last couple of decades. We've been able to basically extract goods from the rest of the world and give them our worthless money. At some point the fiddler is going to come to the table and want to get paid. So, that's it's unfortunate, but all right. Well, that's everything I had for today. I hope everyone has a fantastic Wednesday evening. And I'll be back tomorrow with Thursday's Liberty Call. If anyone needs anything from me, don't hesitate to reach out via email or phone. Or, if you want to book an appointment, go to dsafinancialgroup.com. All the information's there to book a meeting with me if you want one. And hope everyone has a fantastic evening. Bye-bye.